do some fishing and talk about depreciation. Welcome back, friends. We are back down here at the river. We started at the river. We're going to finish at the river. It's a beautiful morning. It's a little cool. It's probably about 48, 50 degrees. There's a little bit of a breeze blowing. The water's cool, so the fish are slow, not eating a lot, and very difficult to catch. So we'll see if I have any luck. The gars are actually moving this morning, which is somewhat surprising. They move a lot in the evening. You can see them rolling and jumping in the river. We are trying a couple of different things today. I've got just a normal, grab this over here. Got a normal, just kind of, I'd say a jig with a spinner. It keeps it out of the weeds. So we're going to try that. Not high hopes for that. I am also trying something new today. This is basically entanglement bait. It is a rope, little nylon rope, frayed end. The idea here is that it catches their teeth. This is supposed to work. I've never tried it. We'll give it a try today, see if we have anything. We're also going to talk about some property, plant, and equipment, particularly depreciation, depletion methods. I'm going to start by talking about how the balance sheet and the income statement interact with each other. This is largely a review from when we talked about the balance sheet and the income statement, but it also pertains very tightly to capital, property, plant, and equipment, or fixed assets, and more specifically, depreciation, which is the connection between capitalized assets or fixed assets and the income statement. So the depreciation is when the value that's being used up of an asset is transferred into the income statement, or it shows the flow. So as we've talked about before, when we purchase a fixed asset, we don't expense it, we capitalize it on the balance sheet, because that represents a resource that is available for management to use to generate future cash flows. That's why we capitalize it. Now, to expense it would say that they've used up that resource. For instance, when they pay salaries to the CEO, they have used those resources at that point in time. For that period, it's benefited the company right then. That's why they expense them. So the income statement shows the use of resources and the generation of revenues. When we purchase property, plant, and equipment, we aren't using up resources. We're actually just switching out resources. We're taking cash, and instead of using it to pay salaries or to give back to the investors, we're taking that cash and we're purchasing some fixed asset or some property, plant, and equipment with the objective of using that in the future for some predetermined period of time to generate future cash flows. So that property, plant, and equipment is a resource to the company. That's why it ends up on the balance sheet as an asset. Now, as we use up those resources, they get used up, and the income statement represents the use of resources from the expense standpoint. So as we use up those resources, they show up in the income statement. So as we use resources, as we use up property, plant, and equipment, or so as we use a piece of equipment, we are going to use that to generate revenue, and we are going to show the use of that equipment. So if I start a fishing business and I'm gonna, let's say, catch fish and sell them, which would be a very unsuccessful business because I'm apparently not very good at catching fish, especially in the fall. But let's say I'm gonna start a fishing business. I need to go out and buy equipment. So I'm gonna go buy a fishing reel and a fishing rod. This is a relatively inexpensive one, but it's easy to carry, so it ends up down here a lot. So I'm gonna buy a fishing setup. Let's say I spend whatever, $150, $200 on some fishing equipment. And that is a resource I now have to generate revenue, which is catching fish and selling them is the process of which I'm gonna generate, by which I'm gonna generate revenue. So I buy my fishing rod and my setup, and I now have an asset that I can use to generate revenue. Now, this is not a use of my resources. This is another resource. Now, instead of having cash, I have a fishing rod. Frankly, if I'm running a fishing business, a fishing rod is far more useful to me than cash. So I now have a fishing rod. I take it to the river. I catch lots of fish, and I take them and I sell them to, let's say, fine restaurants in town who aren't going to be buying gar or catfish, which is what I've been catching in the fall. So I sell those fish, I've now generated revenue, and I've used some of my fishing equipment. Now, some of it, let's say I lose my lure, which is not uncommon in a river that floods routinely and accumulates large logs. So let's say I lose lures, I break my rod occasionally, I need to replace my reel when it gets locked up or rusted out, all that stuff, every time I use it, I'm using up this resource. This resource is becoming less valuable, or at least I'm using part of it. The use of that resource is what ends up on the income statement as an expense for that period. in which in this case, if I'm catching fish, it might end up sitting in inventory. As I have fish sitting in inventory, I'm going to actually just essentially move that depreciation from the property, plant, and equipment into inventory. And then when I sell the inventory, it would go through cost of goods sold. In case this is with the direct objective of producing inventory, can be tied to that inventory, so it would actually probably go to inventory first. But the whole point of the balance sheet are resources available from an asset standpoint, are resources available that I can use to generate revenue. As I use those resources, as they generate revenue, I expense them, in this case through depreciation on the income statement. Now, I'm not trying to capture, in that case, I'm not trying to capture the value of this fishing equipment at any point in time. So when I use this the first time, the value of the rod may have changed, it may not have changed, it doesn't matter. I'm not trying to capture the value of the rod and the reel. I'm not trying to capture the value of my assets. I'm just saying this is a resource, that this is what I paid for it, that I can now use. And the question is, how much do you get to use that? Well, I'm now going to apply that to the revenue it's generating. And that shows me if I made a good decision and my rod and reel are profitable, I'm going to have a net income. If they are not profitable and I continue to I use them up without generating revenue, I'm going to have a net loss, which is I'm running at a net loss this fall. So that's the connection between the balance sheet and the income statement in terms of having a resource or an asset, using that resource, and the depreciation is capturing the use of that resource as it hopefully is generating revenue. So that's a quick high-level overview before we move on to some depreciation concepts and methods of depreciation. So with that said, let's continue on with depreciation methods. So depreciation is the accounting process of allocating the cost of a tangible asset to expenses in a systematic and rational manner to those periods expected to benefit from the use of the asset. Going back to my discussion of my fishing rod. Some key terms here, it has to be systematic and rational. That is the only criteria, which means you can come up with all kinds of crazy things of ways to do it. As long as it's systematic and rational, you're within the level of GAAP. Now, with that said, most people use straight line, which we'll cover here in a minute, which is very simple and straightforward. So this is allocating costs of long-lived assets. So fixed assets would go into depreciation expense. Intangibles we actually amortize, so they're an amortization expense. And natural resources like, say, gold and oil actually get depleted because you're actually using those up, so they are depletion. So those are kind of how we allocate long-lived assets. Most of what we'll be talking about, at least first thing this morning, is going to be fixed assets. Intangibles will be covered at a later point in time, and natural resources we'll talk about probably towards the end of this overall module in probably the next 1 or 2 videos. So some factors involved in the depreciation process. So 3 basic questions. Question 1, how much of the asset is used, or how much of the asset will be used? That is our depreciable base. That's a question of, okay, so I have this fishing rod. When I buy it, it's whatever, say $200 for my equipment. How much of that am I going to plan on using? In the case of a fishing rod, I'm going to basically use it until it stops working, which means I'm going to use 100% of it. So my depreciable base in this case is the full $200 that I paid for it. Now, alternatively, let's say I also bought a boat, which would be a lot of fun and would maybe improve my fishing, but I don't have one right now. So let's say I bought a boat. Now, I may buy a boat with the idea of, like, I'll use it for some period of time and then it'll stop becoming useful to me, and I'll sell it and buy a different boat. Now, that boat has some salvage values. What we refer to that as is a point of, like, when I stop using it, it still has value, and I will sell it as whatever, an empty hull with a broken motor on it or something. So how much I'm using the asset is just essentially the difference between what I paid for it. Let's say I paid $20,000 for my boat, and the salvage value is going to be $2,000 at the end of what I think is its useful life. Then I have an $18,000 depreciable base. So that's depreciable base. That answers our first question of how much of the asset we're going to use. The next question is, how long do we plan on using this asset? Now, the length of time, the length we use the asset, that can be, we call it its useful life, but that can actually be in terms of a time frame. So I could say 10 years, or it could be in terms of hours. Let's say I plan on getting, I don't know, 2,000 hours out of my boat of use. It doesn't matter. Like, that's how long I can use it. And depending on the asset and how I'm going to do my depreciation, was going to change how I determine what my metric is for how long I use the asset. And lastly, how do we apportion the cost to the periods? And this gets back to our systematic and rational method. How do we assign costs to the period over which it's generating revenue? So, starting out with the depreciable base, kind of already talked through that. We take our original cost minus our salvage value. That gives us our depreciable base. Moving on to the estimation of the useful or service life. So the service life often differs from its actual physical life. Now, in the case of my fishing tackle, the useful life is its service life. I'll probably use this until it stops working at all. So they're largely the same thing, service life and useful life. But again, there's other factors that may come into play regarding the asset. For instance, let's say I got a fish finder, which again, all of these things would help me catch fish, but I enjoy fishing and catching fish is just a bonus. But let's say I bought a fish finder. Well, fish finders are an ever-changing technology. They are constantly getting better. They're constantly also getting more expensive. So they're constantly getting better. So the useful life of a fish finder might be very short, 2, 3, 4, maybe even 5 years, because at some point it could just become obsolete. And it's like, well, yeah, you have it and it shows you some little specks on the bottom, but I have one that shows me the size of the fish and how deep they are and how fast they're moving and what color their tail is. I don't know. So in that case, the service life, say if the fish finder is obsolete after 5 years, the service life is quite a bit less than its physical life. That fish finder might last for 20 years, although it only has any value for, say, the first 2 or 3. Like a lot of technology falls in this category. The question is like, okay, does your phone might still work, but does it work sufficiently well to be useful, or do you need to trade it in because it's essentially obsolete? So there could be physical factors or economic factors that drive a service life less than, say, the physical life of something. So that's just going to determine how long you're going to use this. And again, we're focused on how long you use it, not necessarily how long it will last. For instance, that fish finder will last for 20 years. I'm not going to depreciate it over 20 years. I'm going to depreciate it over 5 years, which is probably its service life. And then I'll give it to some poor kid who can't afford a fish finder and wants to really catch fish. Anyway, the last thing we want in this is our method of depreciation. And this is where we're going to spend most of our time in this lecture for sure. Our method of depreciation. So GAAP requires, as I mentioned, that we employ a systematic and rational method to allocate the cost of the asset to net income, or basically as we expense it. So a systematic and rational method. There are a bunch of different methods, and frankly, a company can come up with anything they want as long as it's systematic and rational. But there are a number of different methods that I will be covering today, walking through some detailed examples of. So we have an activity method, which is units or use of the product. So that would be like the use of, say, hours on my boat. If I'm going to depreciate based on hours usage, that would be an activity method. Straight line, which is predominantly across the board the most common, and that's just the useful life divided by, or the cost divided by the useful life. And that would show us but basically we depreciate the exact same amount every single year. Then there are some decreasing charge methods. That's the sum of the year's digits and declining balance, which are a little more complicated, but the idea there is we're taking a lot more of the expense in early years than in later years. And then you can have hybrid methods, which is you can group assets or you can combine all kinds of different methods if you want. Whatever kind of works for you, as long as it is systematic and rational, it's allowed under GAAP. So with that, let's launch into some of these. Here's our example. We're going to take Stanley Coal Mines. So Stanley Coal Mines, this is our example. We're moving beyond fishing to coal. We have a crane. We're buying a crane for $500,000. It has an estimated useful life of 5 years, an estimated salvage value of $50,000, and a productive life in hours of 30,000 hours. So if Stanley uses the crane for 4,000 hours in the first year, what is the depreciation charge? So we are going to do the activity method first. So if they use the crane for 4,000 hours in the first year, what is our charge? Well, the total life of this crane is 30,000 hours. The cost of the crane is $500,000. So to figure out our depreciation charge, we're going to figure out how much of the total productive hours did we use this year. So 4,000 basically divided by the 30,000 hours you can use, and then we're going to multiply that times our salvage value. Our depreciable base. So we start with our depreciable base, which is the cost less the salvage value. So our cost of the crane is $500,000. Our salvage value is $50,000. So our depreciable base is $450,000. Now, $450,000, we're going to multiply $450,000 by the hours used divided by the total hours. So we used 4,000 of the 30,000 hours. I'm not going to try to do that math in my head, but basically we used 4/30ths, or what would be 2/15ths. So we used 2/15ths of this crane. So we're going to multiply $450,000 times 2/15ths to give us our depreciation charge, which if you run the math, that comes out to $60,000 is our depreciation expense for this year using the activity method. Now, that is the activity method that uses hours. And the idea is we don't know how long in terms of years this crane is going to last, but we do know how many hours we're going to run this crane. That's the activity method. If we move on to our straight line method, as I mentioned before, the straight line method is predominantly what is used. I would say in all of my years of working in practice, I bet 98% of what I saw was straight line method. And that might even be low. I don't know if I saw anything other than straight line method except for tax depreciation, which is its whole own world, which you'll get the privilege of learning if you continue on and take a tax class. So apart from tax depreciation, we have straight line method, which is almost universally what's used. So straight line method, same set of facts and circumstances. Our straight line method is very simple. We take our cost minus our salvage value. So we take our depreciable base divided by the estimated service life. That gives us our depreciation charge. So our depreciable base is $450,000. Our estimated service life is 5 years. So our charge will be $90,000 every year. And we do that for 5 years. At the end of 5 years, we will be done using up this asset, and we'll work from there. So that is straight line method. It's simple, and that's why most companies use it, because there's no great value to the company in having anything more complex. I will also say it's also incredibly difficult to figure out exactly how much revenue an asset's going to generate at any point within its life. So straight line just kind of makes the general assumption that this asset is going to generate the same amount of revenue in year one as it is in the last year of its life. So I'm going to straight line depreciate, say, my fishing rod, because I expect it to generate just as much revenue the first year as I have it as the last year I have it. So assuming that, I want to allocate the cost of this rod evenly over its entire useful life. So that's straight line method. If we move on to a decreasing charge method, so we take, again, same facts and circumstances for Stanley Coal Mine. We're going to take a sum of the years digits. We're going to cover two decreasing charge methods. The first is the sum of the years digits. So for the sum of the years digits, instead of just straight lining it, we want to depreciate more early on in its life and less at the end of its life. So what we're going to do is we are going to take the sum of the years digits as our denominator, and we're going to take how many remaining years, or how many years it has in its useful life left. So if we take, say, it has a 5-year useful life for this asset, if we sum up all of the digits, so when we say digit, that means years. So we have 5 years. So we're going to sum 5 plus 4 plus 3 plus 2 plus 1. So that's 15. So it's a 5-year useful life. If we add up the number of years as 1 plus 2 plus 3 plus 4 plus 5, that gives us 15. That is our denominator. And our numerator is going to be the number of years left. In our first year, our depreciable base is $450,000. Our remaining useful life is 5 years. So we take 5/15 times one, it equals $150,000. That is 1/3 of 450, or 5/15 of 450, which gives us an ending book value of $350,000. In the second year, we take in the second year, we have 4 years useful life remaining. So we take 4/15 times 450, et cetera, et cetera, et cetera. And you see in this table how that works out as depreciating off the full useful life. So that is some of the year's digits. I would like to say, I'd say if someone stayed up late one night trying to figure out that method, but it is systematic and rational, more systematic than rational, but people, apparently they use it because it's been taught for, say, 50 years. But there are some of the year's digits. The next declining balance or declining charge method is going to be is called the declining balance method. The most frequently is what's called double declining balance, in which case you take double. This is why it's called double declining, but you can take any ratio for a declining balance method. So a declining balance, the declining balance method utilizes a depreciation rate that is some multiple of the straight line rate. So if we take, say, our 5-year useful life, that would be 1/5 gets depreciated every year. Well, if we take double declining, then we're going to depreciate 2/5 every year instead of 1/5. Now, that doesn't add up because then you would end up depreciating too much, which is right. So there's a couple things we do to compensate for that. So one, we don't consider any salvage value when we start depreciating. The salvage value, when we hit salvage value, we stop depreciating. But initially, we don't do anything with salvage value. And the amount of depreciation every year is calculated on the net value of the asset that we're depreciating. So in the first year, in this case, we have a $500,000 crane. If we took, say, double declining balance, the first year's depreciation would be 2/5 times $500,000. That would be the first year's depreciation. In the second year, 2/5 would be $200,000 would be our expense in the first year. So our first year, as I mentioned, we would have $300,000 would be our book value at the end of the year. Now, in the second year, we take the $300,000, we multiply that times our double declining balance, which is 40% or 2/5, which gives us a depreciation expense of $120,000 and a ending book value that in the end of the second year of $180,000. Now, we continue doing this every year of its life until we hit salvage value. As I mentioned, we don't consider salvage value when we start, we consider salvage value at the end. We just stop depreciating when we hit salvage value, which in this case is in our 5th year. We hit salvage value and our 5th year runs it whole way down to $50,000. When we hit $50,000, we stop. If you do the math, the last year, it's not a full 2/5 of the depreciation. It's actually, we would depreciate it lower if we continued the method, but we stop when we hit salvage value. So $50,000 is where we stop depreciating at the end of 50 years. And that is the declining balance method. And specifically this example that I just walked through is the double declining balance method. So that pretty much wraps up what I wanted to cover for this section. So with that, have a great day. God bless.